Going. All right, well, welcome everybody. Hope everybody had a great weekend. Welcome to the Nadex Application and Strategy webinar series. My name is John Skelton. I'm with Apex Investing. We're going to talk tonight about how to trade Nadex spreads directionally. If you've been with us before and been familiar with trading Nadex binaries and spreads, hopefully you're familiar with spreads and you've tried those out. And we're going to talk tonight a little bit about spreads, kind of review a little bit of the spread basics, and talk about how to trade them directionally. So let's hop right in. We don't want to keep you too long here tonight. Let's get our disclosures knocked out as usual. Trading futures, options, or any financial instrument involves risk, may not be suitable for every investor. Information presented here in this webinar is for informational and educational purposes only, and it's not an offer or a solicitation of an offer to buy or sell any particular financial instrument offered by Nadex. And as always, past performance is not indicative of future results. So, speaking of Nadex, if you're brand new, make sure you hop on over to nadex.com, and you can go through the different tabs there on the Nadex website, get some good information about the different products that Nadex offers. Basically, Nadex offers binary options and spreads. We're going to be talking about spreads tonight, but also want to direct your attention right here to trading platforms. You can go right here to trading platforms, go down to demo trading platform, and Nadex will give you a free $25,000 demo account. All right, that way you can get familiar with the platform, get familiar with entering and exiting orders. You can test out any new systems you have using your demo account. It'll just take you a quick minute. In fact, if you don't have one, do it right now. Even while we're on this webinar here, all you got to do is fill out some quick information, select a username, and then in just a few moments, you'll get an email with a temporary password, and you can log right in to a demo account, okay? And we'll probably reference this account here several times tonight, but it's a great place to just get familiar. And like I said, anytime you're practicing any new strategies or systems, definitely want to do that in your demo account and get that mastered and get rolling, and then jump over to live from there. Okay, and like I said, my name is John Skelton. I'm with Apex Investing. Apex and Nadex, two completely separate different companies. Nadex is an exchange. Apex, we're an online company of traders helping traders. We have over 20,000 members. We're very education based. We're a Nadex education partner. We do these webinars each and every Monday night at 7 p.m. Eastern Time. We do these Nadex application and strategy webinars, but we're traders just like you. We trade Nadex binaries and spreads every single day. And I've been with Nadex, or with Apex now, for about 3 years. I've originally got a history in banking, and I was a licensed stockbroker with Smith Barney for several years. And like I said, I'm a trader just like you. I trade Nadex binaries, Nadex spreads. Love trading the cap risk Nadex products. And so that's what we're going to talk to you about a little bit tonight. Directional trading with Nadex spreads, how to pick the right spread. We're going to talk a little bit about some directional strategies and some daytime and nighttime trading with Nadex spreads. Some people think, oh, I can't really trade those spreads because I work during the day. I'm a part-time trader. I only trade at night, so, I only really trade the binaries, which is great. Maybe you're a binary trader. I trade them both. I love binaries. I love spreads. But that's a common misconception. There are plenty of potential opportunities for trading spreads at night and even overnight. We're going to talk a little bit about that. So if you've been with us before and you're familiar with some of the basics of Nadex spreads, you can go back through, you can go to the Nadex site or to the YouTube channel, and you can go back through and catch up on some previous webinars that, I've talked a lot about the basics of spreads and common misconceptions, premium and proximity. We're not going to dig into each and every aspect of that tonight, but we do want to review a little bit of the basics of spreads. Now, one of the great things about trading Nadex is all products are capped risk. Okay, you cannot lose more than you put up. Your risk is the amount that you put up. It's the initial amount you put up or the cost to enter that trade. Okay, but you still get highly effective leverage. You can trade binaries and spreads, derivatives of stock indices, future commodities, and certain Forex pairs. And with the Nadex spreads, the price is driven by the underlying market. It's not driven by supply and demand of the spread, as the market maker is making the market based on where the underlying is located. All right, we'll talk a little more about that and what that means. And it moves in pips. Pips is the last digit quoted. Every digit is worth $1 per spread or being bought or sold. So what is a Nadex spread? For those of you that are brand new, some of you that have been trading spreads for a while, some of this first part here might be kind of elementary for you, but bear with us. We all had to start at some point, and all of us at some point were like, hey, well, what is a spread? How do these things work? Well, I kind of call them box spreads because if you draw them on a chart, they kind of look like a box, okay? All spreads, all Nadex spreads have a top and a bottom, or a ceiling and a floor, okay? So, for example, let's just say we were looking at a chart of the euro dollar here, and let's say the floor of the spread, or the bottom of the spread, was at 1.2400, and the top of the spread, or the ceiling, was at 1.2500. Okay, so the spread is the difference between the floor and the ceiling. So in this particular example, from 2400 to 2500, this is a 100 pip spread. Okay, and again, it moves in pips or ticks, which is the last digit quoted. Okay, each pip is worth $1, and there are 100 pips in this particular spread. So overall, this spread value is 100 pips. Each pip is worth $1, therefore the spread is worth $100 maximum. Okay, so what does that mean? How does a spread actually work? How can you trade it? Well, a couple things here. Spreads are, if you're trading binaries, a binary is a volatility instrument, okay? And it's based off a simple yes or no, true or false statement, all right? And at expiration, a binary is either all or nothing, okay? But you have to take that concept and remove that from your mind when you're looking at spreads, all right? Spreads do not work the same way as a binary, all right? It's not all or nothing. It boils down to, at expiration, $1 per pip. Okay, so let's take a look here. Let's say, for example, we were selling. All right, whatever strategy or system that we're using, whatever charts and indicators we have, we feel that the market is going down. So we want to go short. We want to sell. Well, how does a spread work here? Let's say that we think the market's going down, but the market actually goes up. It goes against us. Well, we can't lose additional money above the ceiling. All right, so 1.2500 is the top or the ceiling of that spread. If we sell, we're saying the market's going down. If we're wrong and the market goes up, we do not lose money past the ceiling here. So let's say we're wrong and the market shoots up 200 pips. Well, it doesn't matter how far it shoots up beyond the ceiling of the spread, because our risk is capped at the ceiling of the spread. So we can't lose additional money above the ceiling. We also don't get stopped out, meaning just because the market comes up and hits the ceiling of a spread, it does not automatically just close out our trade. We're still in that trade until we decide to exit the trade or until expiration. And we can't make additional money below the floor. So if we're selling, saying the market's going down, and we are right and it goes down and it goes all the way to the floor, we make money all the way down to the floor, right? But if it keeps going, hey, we were right, we were really right, it kept going. We don't make additional money below the floor, all right? So the ceiling and the floor, the ceiling on a sell caps our risk, and the floor caps our potential reward. Now, if the market's still going and going, well, we could just get into another spread, and we'll talk about that here. So let's look at a couple examples to make this a little more practical and easy to understand. So let's say that we sold right here in the market when the underlying indicative was at 1.2490. Let's say that that's where we sold the spread at, 1.2490. Well, the ceiling of the spread is 1.2500. We're selling at 2490. So what is the difference from where we sell at to the ceiling? Difference is 10 pips, right? So what is the most we're risking there? Each pip is worth $1 per spread. Now, yes, we can get into multiple spreads, Well, right now we're talking about one spread. Each pip is worth $1, and there are 10 pips. So the max risk is only $10. Okay? So also remember, we can't make additional money below the floor. So if we sell at $24.90 and the market does go all the way down and it comes all the way down to $2,400, the difference is 90 pips. So there's 90 pips of potential profit. Each pip is worth $1, so the profit potential is $90. All right, and again, even if it keeps going below the floor, we don't make additional money below the floor, but we also can't lose above the ceiling. So in this particular example here, we're risking 10 pips, therefore $10, with a potential profit potential of 90 pips. So let's look at an opposite example. Let's say we were buying. Well, we cannot make additional money above the ceiling, and we can't lose additional money below the floor. And again, we're not going to get stopped out just because the market hits one of these levels at the floor or ceiling. So again, whatever strategy or system, charts or indicator we're using, we feel the market's going to go up. We want to go long. We want to buy. Well, if we're right and the market goes up, we're not going to make additional money above the ceiling. But if we're wrong and the market goes down, we can't lose additional money below the floor. So same type of example here. Let's say we buy close to the floor here. We buy at 24.10. Well, same example here. The floor is at 2,400. So 24.10 down to 2,400 is only 10 pips, right? That's our risk. All right? Because each pip is worth $1 and there are 10 pips. So the cost and the max risk is only $10. And we have profit potential all the way up to the ceiling of 2,500. So 2,500 compared to 24.10 where we bought in is a difference of 90 pips. So once again, there's 90 pips of profit potential. Each pip is worth $1, so the profit potential is $90. Okay? So I'm going to back up real quick here. This is a real common question that I see. And people say, okay, well, binaries I understand because it just tells me right there. I know it's either 0 or 100, and I can buy it for 30 or I can buy it for 60. And so if I buy it for 60, I got to put up 60 bucks. That makes sense. I get it. But I don't understand how spreads work. How much money do I have to put up? Well, with Nadex, again, all of your risk is capped. You know upfront ahead of time before you ever get into a trade what that risk is going to be. Okay? And on your order ticket, and I'll show you one here in just a moment, your order ticket will tell you that as well before you ever press enter. And before you ever get into a trade, you'll know exactly ahead of time what your max reward and your max risk is going to be. But just as a quick example here, if you bought right here at 24.10, the most we can lose is how much? We just went through that. 10 pips, right? Therefore, $10. Well, how much do you think you'll have to actually put up out of your account to enter this trade? $1, $10, $100? Right. With Nadex spreads, Eric says $90. Actually, no, Eric, if we're buying here, okay, if we're buying right here at 24.10, okay, from where we buy at 24.10 down to the floor of 2,400 is only 10 pips, okay, and each pip is worth $1, so that's 10 pips of risk there. So the max risk is $10. $10 is the most that we can lose on this trade. So therefore, $10 is all we have to put up to get in this trade. Does that make sense? So this particular spread right here is a 100 pip spread, right? From 2,400 to 2,500. All I have to put up out of my account is my maximum risk. So let's say, for example, that I bought in right here. Let's say I bought in right here at 24.50. Expecting the market to go up. I'm hoping it gets all the way up to 2,500. It maybe I can make 50 bucks. But if I buy in right here at 24.50, well, from 24.50 down to the floor, what's the difference? From 24.50 down to 2400. 50. So the most that I could lose is how much? 50. So what do you think I have to actually put up out of my account to enter that trade? Right, 50, exactly. So if I bought it at 24.30, well, again, it's going to be from 24.30 down to 2400. It's 30 bucks. Yeah, there you go, Richard, got it. So does that make sense? For some of you, that's very elementary, but for some of you, you're like, oh, like I never understood how that worked, or is this a margin? Is it? No, it's not a margin. All you're having to do is put up the amount of risk. So remember when I told you earlier that I like to think of spreads like a box spread, because if you draw it on a chart, it's like a box, right? We've got from 2400 to 2500. There's a top and a bottom. So if I'm buying it, the most I could lose is down to 2400. So wherever I buy in at, I have to put up that amount compared to 2400. Makes sense? Eric says, oh, light bulb. Okay. So does that, everybody understand that a little better now? How that works? Because I know there's a lot of questions that have come up on that, especially since, let's hop over here and let's take a look at the Nadex platform. Let's just go right here to Forex spreads. Okay, and we'll pull up, let's just pull up pound yen for now. Well, you've got multiple spreads here. We've got some spreads that opened up at 6 p.m. and they go all the way until 11 p.m. They expire at 11. Then we have 2-hour spreads. These opened up at 6 p.m. They'll expire at 8 p.m. We had some new ones that opened at 7 p.m. They'll go to 9 p.m. Well, here in about 45 minutes at 8 o'clock, what will happen? These 6 to 8s will disappear at 8 o'clock, right? Because they've expired. But then what do you think is going to pop up next? 8 p.m. to 10 p.m., right? It's every hour on the hour we get another 2-hour spread on Forex. And then we also have the dailies that go all the way to tomorrow at 3 p.m. in the middle of the afternoon. But notice there's more than just one spread. You see that? Even these here from 6 p.m. to 8 p.m., these 2-hour spreads, there's 3 different spreads. Notice that? They have different floors and ceilings. So sometimes you'll be like, okay, well, that's what I never understood, because if I want to buy this one and I just click buy and I say I want to buy 1. Well, look, max loss $6, max profit 94. Sweet. I only have to put up $6. I like that. Okay, well, what about this next spread? If I want to buy this one, oh wait, now I got to put up $43. Okay, how about this one? What if I buy this one? Now I got to put up $90. Why are they so different? Well, because again, notice, where is the indicative at? 133.39. Okay. Well, this particular spread has a bottom or a floor of 133.50, and it goes up to 134.50. So where can you buy it? Right here, where can you buy this at? You can buy it at 133.56. So if you're buying something at 56 and the floor is at 50, what's the difference there? $6. So how much do you have to put up? Remember? $6. Remember that when we looked at this one? How much? $6. Okay. Now notice this middle spread. Oh, wait a minute. Now I get it. This one has a floor of what? 133.00. So this one has a floor 50 pips lower. So that means you're buying more where? Right in the middle of the spread. Correct? Does that make sense? You're buying more in the middle of the spread. All right, and then we get down here to this one. It's got even a different floor. So does that make sense why there's different amounts that you have to put up? Because imagine that box on your chart, and where are you buying in that chart, and what spread are you using? Okay, now one other common question that we get, that I hear a lot, let me just have a quick show of hands. How many of you right now are kind of new to spreads, or how many of you are thinking to yourself, well, why are there 3 different spreads? Why are there different floors and ceilings? Just quick show of hands. Is anybody thinking that right now? Why are there different ones? Why are they different? And then you're thinking, well, who comes up with those? Are they just randomly figured out? Well, let me show you. And this is going to be another kind of aha light bulb moment. All right, so pound yen, 6 p.m. to 8 p.m. That means these spreads right here opened up at 6 p.m. Now, who can tell me, without looking at a chart, without looking to see where the pound yen was at 6 p.m., can anyone tell me approximately where was the pound yen indicative price, you know, the current price, where was the pound yen at approximately at 6 p.m.? Just by looking at this screen right here. Not even at a chart. Don't look at it online. Tell me by this screenshot right here. Yep, Ezra and Doug got it right. Is it 133.50? Okay, how do I know that? Well, here's what happens. So these spreads are going to open up at 6 p.m. Well, a couple minutes before, wherever the current price is, okay, that is what the new spreads are based upon. They're not just randomly based on some number that Nadex picks or some market maker picks or whoever. It's based on where is the market at right there before 6 p.m. And the market was at 133.50. So these spreads right here, these 2-hour spreads, okay, these are 100 pips wide each. So how do I know that it's 133.50? No, Clyde, doesn't matter which way the market's going, up or down. Okay, and here's why. Clyde says, isn't this assuming that the market is bullish? No, it doesn't assume that the market's going up or down. Just at 6 p.m., wherever the market is, there's going to be 3 different spreads. Let's take a look here, Clyde. So the market was at 133.50. How do I know that? Notice that right here, 133.50. That is the what? The ceiling of this particular spread, isn't it? Because look at this spread. This spread is 133.50 down to 132.50. So that's the ceiling of this spread, right? Everybody understand that? 133.50 is the top of this spread. Everybody follow? Now look up here at the top spread. 133.50 is what? The bottom, the floor of this spread. So the market was at 133.50, right? So what did they do? They made a 100-point spread from 133.50 going down 100 pips. They make a 133.50 spread going up 100 pips. And then what's right in the middle? 133.50 would be right in the middle of this spread here, 133 to 134. You see it? Let's make it look a little bit different here. So 133.50. Okay? Here's a pound yen chart. So what did they do? Let me just add in something real quick here. We need to be able to draw. So I believe it was Clyde asked, wasn't this assuming it's bullish? Well, now you see, Clyde, it doesn't matter. It all is based on where was the market at. Okay, so the market was at 133.50, right? So here's 133.50. Okay, everybody see that? So it's at 133.50 going down to 132.50, right? So that's one spread there. And this is a spread going down. So if we were bullish or if we were bearish, we thought the market was going down, we might be interested in that particular spread, right? But then they also made a spread that was at 133.50 going up 100 points, 100 pips, right? I'd have to squish it here. I think you know where I'm trying to show you here, but let's just kind of try to get it right. So we basically have a 100 pip spread going, so the market was right here at about 6 p.m. We have a 100 pip spread going down, we got a 100 pip spread going up. Does that make sense? Everybody see that here? 133.50 down, 133.50 up. And then notice there's one right in the middle. So what that means is from 134, 134 down to 133. Which means if we got into that middle spread, so if the market was right here, we got in this middle spread, we've got about 50 pips up we can go, or 50 pips down we can go. So we've got three different options there. Okay, does that make a little more sense now? How many of you have always wondered, how do they do those? Like, why are there three different ones? Well, Clyde asked the perfect question. Isn't that assuming the market's bullish? No, it can be bullish or bearish. Nadex has no biased either way. They're going to give you an option to go either way. In fact, they're giving you three different options to choose from just in those 2-hour spreads. In addition to that, you've got the 6 to 11 p.m. spreads that are even wider. These are not just 100 pips. Okay, these are 250 pips. Okay, and then you've got the 3 p.m.s tomorrow that are huge. Like you've got 4 different ones to choose from, and these are 250 pips. And these have all kind of different floors and ceilings for you to choose from here. Okay, Cheryl says, oh wow, I always thought Nadex chose it. No, it's not just random, Cheryl. You always know that that's how they do it. And I believe it's figured 2 minutes before they open up. So like the ones that are coming up here at 8 o'clock, I think it's 7:58, wherever the market is, it's rounded off and boom, there you go. So that being said, just for example, on these 2-hour Forex spreads, okay, we get a new one every single hour. Notice, okay, remember the 6 p.m.s, 133.50? What about the ones at 7? 133.40. See the difference there? Well, see where the market was over here closer to 6 compared to where it was at 7? It went down. So that's where they opened up. So what is the one thing then that you know that's going to happen at the top of every hour on these particular Forex spreads we're looking at? Some people tell me, oh man, I can't ever find a spread that I want. Oh, I can't ever find a spread that's close to the floor or close to the ceiling. Really? You've got 6 p.m. to 11 p.m.s. You've got 3 to choose from there. You've got 6 to 8 p.m.s, 3 to choose from there. You got 7 to 9, 3 to choose from there. And you've got dailies here. You've got so many different spreads to choose from. But what is the one thing that you know is going to happen at the top of the hour? You know there's going to be new spreads that open up right at where the market is. Right, you'll always at the top of the hour have a new spread that's what? Right at a floor or right at a ceiling, right? Does that make sense? So, yeah, and you always have, Oscar said, either it goes up or down. Yeah, I mean the market can move, but then at the top of every hour there's going to be new spreads that come out that are going to be right there at the market. Okay. Jason, I think you might have something on your keyboard there. The plus sign keeps coming through from you, buddy. Okay. Eric says, can we buy and sell the same spread? Well, you can't buy and sell the same one at the same time, Eric. You can buy a spread and then you can get out of it, okay? And that's a perfect question. Let's talk about that here. So you can close the spread at any time before expiration, okay? So wherever we get in the spread, if we got in the spread here and it comes up here, we can sell out of it early or buy out of it early, okay? We don't have to hold it till expiration, okay? You can get in and out of a spread at any time before expiration as long as there's a quote there. What do I mean? Well, notice right here on these spreads. Let's say I bought this spread. The offer side is what I can buy for. The bid side is what I can sell for. So if I bought into this spread, I can hold it until expiration or I can exit it early. And what is the amount I can sell it for? Well, whatever the listed bid price is there for me to sell out of it. Okay? Some people say, well, what do you mean? How do you do that? What do you mean get out early? Well, it's very simple. Let's say I went in and I had bought this spread, this particular spread. Okay? And, no, it moved on me. Hold on. Let's see here. So let's say I bought this spread right there. All right, so it's right here in my open orders. Let me get rid of this one. So it's right here in my open positions, right? See it, +1. I bought this spread. Well, what can I sell this spread for right now? 133.14. Whatever is listed right here, that's the price I can sell it for immediately. So all I have to do is, it's here in my open positions, I just click it, it automatically pops up a ticket marked what? Marked sell. Because I bought it, right? I bought it. So Nadex knows if I'm clicking that one to get out of it, the only way I can get out of it is to what? Sell it. Right? Does that make sense? So, and all I have to do is sell it. And it's gone. Okay? So I can exit early or I can hold it until expiration. If the spread expires, it will close at the settlement price at the time of expiration. The settlement price is based on the underlying market. All right? So whatever the indicative settlement price is at expiration, that's what I would get. Now, let's look at something real quick here though. Okay? Oscar, yeah, give me just a second. I'll talk to you about that, about the different spreads there and why you might want to look at the middle one. Okay? We're actually just a couple of slides away from that here, but that's a great question. So let's talk about something. Let's say, let me back up a little bit here. So let's say that I sold this spread. No, let's say I bought this spread, and I think the spread's going up. And it goes all the way up, all the way up, all the way up to the ceiling. And it's still going up. Am I making anything past the ceiling? Or have I already reached my profit potential limit? Right. I'm not making any more past the ceiling. So would I want to get out of the spread right away when it hits my ceiling? Or would I want to just leave it open? Well, that's totally up to you, what you want to do there. Okay? Yes, if you get out of it early, you'll pay some bid-ask spread to sell it back. But so let's say I bought it way down here. And man, it's going up, it's going up. I'm happy. I love this trade. I'm feeling good. Bam, it gets all the way up here. Man, I'm feeling good. I made like 90 bucks. Right? I'm going to run outside and go mow the yard. And I come back 20 minutes later, and where is it at? All the way back down here. Am I freaking out? Am I kicking myself? Yeah, I'm having a heart attack, right? Thinking, what did I do just to stay in it for a few dollars more, because I didn't want to pay bid-ask spread? Now, luckily, this particular one came all the way back up here. But remember, just because the market hits a floor or hits a ceiling, it does not close out your trade. Even though you've reached max profit potential, it doesn't just close out your trade. You're still in the trade, okay, unless you close it out. Otherwise, if you left it open, it came all the way back down, it came all the way back up, then it expired right here about, 24.80 or something. So you still made money, you're happy, but you didn't quite make as much money as if you had closed it out at your max profit, right? Cheryl, exactly. So in a way, you don't get stopped out. So let me show you a perfect example. Cheryl, let's say that right here, let's say okay, show of hands. How many of you had ever said, okay, I think the market's going up, my system, my strategy, my charts, my indicator says the market's going to go up, so I buy. And as soon as I buy, I'm telling you, the market's out to get me. It's just out there to get me, because every time I buy, it comes right down real quick, takes me out, takes out my stops, then it goes up. It's like they were just wanting to take my money real quick before they went up. And you take it very personally, right? Show of hands, we've all had that happen, right? So, check this out, Cheryl. Let's say I'm right here, and I want to buy because I think the market's going up. So let's say I bought right here at like 24.10. Remember, we talked about this? So I got like $10 of risk. I think the market's going up. But what does it do first? Boom, shoots right down. How much did I lose? Or how much am I down? $10, right? Because I bought at 24.10, I can only lose money to 2,400. Am I really stressing right now? Not really. Market shoots down, then what does it do? Comes back up. So I'm glad it didn't kick me out, right? My trade is still open. I have more time to be right, and with capped risk to be right. So then what happens, Cheryl? It comes right back up and comes all the way back. So that is exactly why it doesn't automatically just close out at a floor or ceiling, okay? It's there for a reason, so you don't have those whipsaws. You don't get kicked out when, ooh, it's going to go up. Yeah, it did, but not before it whipped back against you real quick. Like if you're trading spot Forex, for example, and you said, okay, I'm going to get in here, but if the market goes down to here, I'm going to get out. So you get in here, market pops down against you, you lose a bunch of money, and then it goes your direction. You're like, oh man, you don't have to worry about that with a Nadex spread. Your risk is capped right up front, and it doesn't stop you out and close your trade just because it hits a top or bottom. It keeps you in, okay? But on the opposite side of that, once you've reached max profit, there's really no reason to stay in because you're not making more past that floor or ceiling. Okay, does that make sense? All right, let me just take, all right, perfect. So let's see here. Yep, Jim, you could do that. You could place a take profit order up there towards the ceiling to close it out. Absolutely. Jim's asking, can we place the limit order at the ceiling to close it? Gerald's saying, can we auto take profit? Yes, here's how you do it. So in this example right here, so let's just say I bought this spread right here, okay? So I bought this spread. This spread is from 133.00 up to 134.00, right? Where did I buy in at? Average price. I bought in at 133.26. Okay? Let's just say, for example, that I want to try to make whatever. Like maybe I want to get out of it right at the ceiling. But let's just say I want to make $50 on it. Well, if I bought it for 133.26, what would I need to make $50? I would need it to go up to 133.76, right? I would need the bid price here to get up to 133.76. So I'm in this position here. I bought it. Remember I showed you a minute ago how to sell out of it, right? You click it, a ticket comes up already marked sell, and you sell it. Well, when this ticket comes up already marked sell, what price is it marked to sell at? It's automatically going to be whatever this current price is. But I don't want to sell it right now at 133.16. I don't want to sell it till it gets to 133.76. I'm going to change it to 76. And then I'm going to say place order. Where did that order go? Down here in working orders. Why is it working? Well, because it hasn't submitted yet. Why can't it submit? Well, because my order said don't sell it until it gets to 133.76. So now I have a take profit order in place. So I bought it, boom. I put my take profit order in there, boom, and there you go. Patrick says, virtual applause, aha. Does that make sense? And so when this order executes, boom, it closes that order out. And that's your take profit order. So yeah, you could do it based on where the ceiling or floor is. You could do it based on the number of pips you want to go for. You know, some people say, okay, well, if I'm going to buy this spread here, I have to put up max loss 23 bucks. So I'm going to risk 23 to make 23. So I'm going to put my take profit order at 23. I want a 1-to-1 risk reward ratio. Whatever it is, whatever your strategy or system is, that's all different. That's personal preference there. But that's how you do it. Okay? John says, what about on a sell? On a sell, it's just the same thing, John. All you got to do is, let's get rid of this. Okay. It's the same thing, just kind of opposite. So let's say that I sold this spread. Okay, instead of bought it, let's say I sold it. All right, so there's my open position. I sold this spread. Notice it says -1. Remember earlier when I bought, it said +1. When you sell, it says -1. Okay, so where did I sell it at? Well, I sold this particular one at 133.15. Okay, but the floor is only at 133. So what's the most I can even make on this? 15, right? So maybe that wouldn't be the ideal spread to choose. Maybe it would be. It's up to you. But hey, I know that if it gets down there to the floor, I'm not going to make any more if it keeps going down. But it could come up against me and I could lose. So I want to get out of it right there at the floor if it hits the floor, right? So I sold it at 133.15, which means I want to buy it back at what? 133.00 maybe? At the floor itself, right? So same thing. I sold this contract. In order to close it early and buy it back, I just got to click it. Ticket comes up already marked buy. And currently it's to buy for the current available offer price of 133.25. I don't want to buy right there. I don't want to buy it back until it gets down to the floor. Because what do you want to do in business? Buy lower, sell higher. Either way, right? Whatever way you're going. So, it's got to be one above the floor. So 133.01. Place order. And now it's sitting in there. So that working order is set there. It won't buy it back until it gets all the way down right there by the floor. Okay? Does that make sense there? How to enter orders for spreads and how to place your take profit orders. Okay, and also, once again, does it make sense why you don't get stopped out when it hits the ceiling or floor? That's for your benefit, to let it move against you a little bit and then come back. You have more time to be right. You have more flexibility to be right. The market can go against you, but you're covered with your capped risk floor and ceiling. But you just have to keep in mind, once it hits your max profit, you might want to go ahead and close that out. Okay? So, yep, cap profit and cap profits and cap risk. Yep, you can get them more cheaper. Yep. Then buy cancels out, the sell does not stay open. Correct, Sandy, that's correct. Because you cannot buy and sell the same spread at the same time. Okay? So if you already have this position open and you've clicked it and you've adjusted an order for it and it's working, if it buys this, it's going to buy the one back that you already have. Because you can't buy and sell at the same time, the same spread. So if you buy one and then you sell out of it, it's always going to just get rid of the one you have right there. You can't be in the same spread long and short at the same time. So yeah, Sandy, it'll close that out for you. So let's see here. Oscar, why would one deal with intraday spreads if daily spreads give more time to be wrong? You can create, why would one deal with intraday spread if daily spread gives more time to be wrong? Oscar, you're saying why would you want to do the 2-hour spreads instead of doing the big dailies? Or are you saying the opposite? Maybe I wasn't quite following you there. Well, let's talk about that, okay? Because there's been a couple questions. Well, okay, that's great. Spreads seem cool. I understand how they work, $1 a pip. I love the capped risk, but which one should I choose? Well, that is, first of all, not an easy question to answer, because that's kind of not a question I can answer for you, because it all depends on what you're trading. What is your strategy? What is your system? What charts and indicators are you using? That's part of the reason Nadex gives you so many different ones to choose from. I mean, just on pound yen right now, like I said, you've got some from 6 to 11 with different floors and ceilings, 6 to 8, 7 to 9, or some going all the way out to tomorrow. So it first of all boils down to a couple of things. These 2-hour spreads, for example, remember we talked about this. How wide are these spreads? 100 pips, right? Okay, these are 100 pips each. So if I was to get into one of them in the middle, I'm going to put up about $50, right? Well, but what if I get into a 250 pip spread or 150 pip spread? Or, I mean, there's some, you know, spreads on some of these other instruments that are hundreds wide. The bigger the spread, okay, the bigger the spread is, you've got these 100 pip spreads, but what if when you have a 250 pip spread, for example, and you want to get in right in the middle? Well, you're putting up the amount of from where you enter all the way down to the floor. So the amount that you put up on these longer term spreads and these bigger, wider spreads, you're going to put up a little bit more than you do on some of the smaller spreads. Okay? Does that make sense? It's going to cost you a little more money up front to get into them because there's a bigger difference to the floor or ceiling. Now, on the other side of that, let's say you get into one of these smaller spreads and the market shoots up. Like you were right, it did go up, but it shot way up. Did you make any more past this point right here? When the market shot way up and you're right? No, but you could have been this bigger spread. Now, I'm not saying you can't try to just get into another smaller spread, but there's pros and cons to both, okay? And neither one of them is really a pro or con. It's all about your strategy or system. What do I mean by that? Well, what are you looking at? Are you a long-term trader? Meaning, or are you a quick scalp trader? What is your strategy or system focused on? Are you using 1-minute charts or like 5-minute charts where you just want to know what is the immediate direction of the market? What is the market doing right now? My strategy or system focus on where is the market going the next 5 to 30 minutes, the immediate quick direction. If my strategy or system is focused on the next, like, you know, few minutes or 30 minutes. Do I necessarily need a big, long, wide spread that I'm going to have to put up more money on that goes until 3 o'clock tomorrow afternoon? Or am I probably more interested in a spread that maybe goes till like 9 o'clock? I mean, these are still open from 6 to 8, but I've only got 8 minutes left on these spreads. The market might not quite go where I think it's going to go in 8 minutes. So maybe I want an hour and 8 minutes, because my strategy or system is just looking at the next 5 to 30 minutes, the immediate direction. Or maybe maybe I use 10-minute bars, and I'm looking for just the next couple hours, the overall direction of the trending market for the next couple hours. So I need longer than till 9 o'clock, but 11 o'clock is great for me. I don't need all the way till tomorrow, but 11 o'clock, maybe that's good for me. Or maybe my strategy system is longer term. I look at hourly bars with my strategy and system indicators. And, with the overall direction of the hourly bars and what my system's telling me, I need as far out as I can get. 9, 8, 9, 11 o'clock tonight is not going to do it for me. I need all the way to tomorrow afternoon to let the market make its big overall move. Okay? And then from there, once I determine what is my strategy or system, how much time do I need to be right, that can help me determine my expiration time of, okay, I need till this amount of time to be right. Then from there I can go into, okay, which one of these spreads, which one has the floor and ceiling that's best going to suit what I need it to do? Meaning, which one is closest to the floor or ceiling and will cost me less to get into? Or, hey, which one has the furthest away ceiling if I want to buy, or which one is going to move the fastest? So it kind of starts with what strategy or system you're trading, how much time you need, and how much time you need to be right. Okay, so there are several different things to consider there. Let's see here. Eric, if we buy or sell 5 spreads, are we making or losing that per pip? Eric, I'm not quite sure what you're asking there. Maybe if you can rephrase it, if you buy or sell 5 spreads, are we making or losing that per pip? Oh, okay. So yes, spreads are $1 a pip. So if you have 5 spreads, is it $5 a pip? Is that what you're asking? Because yes, that's correct, because it's $1 per pip per spread. So if you had 1 spread, 5 spread, or right here, there's 20 available. If you had 20, then it'd be $20 a pip. Okay. Let's see here. Oh, yep. Yep, you're right, Atan. Yep, got a little bit of profit there going, and that wasn't intentional. I was just kind of showing you how that works. But yeah, there you go. Let's see here. Eric, is the drawdown still capped? Yes. It doesn't matter whether you have 1 spread or you take out the whole book and buy all 20 of them. All 20 of them are going to stop losing money on you at the floor and stop profiting money for you at the ceiling. Okay? So, all right. We're kind of running out of time here. Let's move on. There's a couple things here I really want to talk to you about. We've talked about the different expiration times, and I've showed you, about not getting stopped out when it does hit those floor or ceilings. And daytime, plenty of stuff to trade spreads on during the daytime. You've got all the Forex markets, the U.S. stock indices, commodities, gold, oil, tons of stuff to trade during the day. But even at nighttime, there's still great opportunities with trading Nadex spreads. You've got Forex markets that are open, Australia and Japan open early evening. And I mean, just take a look here. I mean, on the Forex, we got Australia and Japan. It's basically morning time there. Those markets are just now opening and moving. And look, you've got Aussie yen, you've got Aussie dollar, you've got euro yen, pound yen, dollar yen. There's plenty of things to trade spreads on. I mean, we were looking at a pound yen chart just a little while ago, and let's move back from over the weekend and go back just to last week. I mean, look at some of these moves. I mean, pound yen moves quite a bit here. We got what, from like 130.70 up to, 130, 170. I mean, there's 100 pips right there. It's $100 on a spread, right? I mean, here's pound yen making a down move at what, 130, 167 down to 120. I mean, pound yen moves a lot. You've got movement at night as well on plenty of these Forex markets. Overnight moves, you've got, Europe opening in the middle of the night, 3 or 4 a.m. You've got morning U.S. session. We've talked about that. There's a lot of overnight news sometimes that affects the Aussie and yen markets. And that's how you use them directionally, because it's just like trading. It's just like trading the underlying market itself, except you're not having to put up thousands and thousands of dollars in margin. You're not having to have tons of money, $500 to $2,000 margin for a futures contract. You're just putting up that risk, and then you can trade it directionally. Whatever directional strategy or system you use that shows you the direction of the market, you can use spreads to trade that directionally and mimic that market pip for pip, tick for tick, dollar for dollar with a Nadex spread, okay? And so whatever system you would use to trade directionally with whatever, if you're trading spot Forex, you're trading futures contracts, you can trade Nadex spreads the same way, okay? They're not like binaries where it all comes down to yes or no at expiration based on 1/10 of a tick. It's not all or nothing. How many of you trade binaries? And at expiration, it's either all or nothing, right, Cheryl? Let's say you buy a binary for $50. At expiration, it goes against you by one tick. One tick. You lose that binary and you lost $50, right? If your spread goes against you by 1 pip, how much did you lose? $1. $1, right? If you're right and you're trading spreads and the market goes from what, 130.11 all the way up to 130, 120 on one spread, that's $100. Two spreads just right here is $200. Three spreads is $300. Okay, all the way up to the cap of your floor or ceiling. Okay, so now proximity. What is proximity? Proximity means buying or selling above the market. That's plus proximity. Negative proximity means buying or selling below the market. Now the price can move slower based on the size of that number. What do I mean by that? Some people are asking, well, why would we ever choose the middle spread? Because we've got, 3 different spreads to choose from. So why wouldn't we just choose one of these spreads that are right close to the floor and ceiling? That way we have a smaller amount that we have to put up. Why would we ever want to do the middle one where we've got to put up more money to get in it? Well, because what happened is the middle spreads move a little faster. What I mean by that is, yes, what I've explained to you is that spreads are $1 per pip at expiration, okay? When you have a spread that's close to the floor or ceiling, it may not move at $1 per tick right away. Let's take a look here real quick. And then we got to wrap it up here. Let's look at some of these spreads here that are really close to the floor or ceiling. So the market's at, notice the difference here that I can buy for. 133.46, 133.14, 133.14. Whoa, wait a minute. Why is this one priced so much higher than this one? Well, because first of all, the market is below the floor. That's not a perfect example to show you there. Let me show you one other one here. When you're getting something right at the floor or ceiling, okay, see these different prices here? Notice this one right here. The market's at what? 1058. Well, where's the floor of this spread? 1060. So do you think you're going to be able to buy something below the floor and have zero risk? Or is there going to be a little, when you're getting something right at the floor or ceiling and you have that lower risk, you're going to pay a little bit of a premium for it. It's kind of like insurance, all right? You're taking that particular spread that's close to the floor or ceiling because it's low risk. It's insurance there, but you're going to pay a little bit of premium for that, just like you do your insurance. So this particular spread right here, the floor is at 1060, but they're going to let you buy it at 1065. So you're going to pay 5 pips of insurance there, but you only have $5 of risk. But they're not going to let you get in at the floor for zero risk. Does that make sense? So if you have to buy in at 1065 and the market's down at 1057, well, if the market goes to 1058 and 1059, do you think you're making $1 a pip right there? No, because it hasn't even got up to where you bought in yet, right? Okay, but look at this middle spread. The market's at what? 1056, you can buy it for 1058, 1059. Okay, those middle spreads move a little bit faster, tick for tick, dollar for dollar, because there's not normally as much premium in those middle spreads or those longer spreads. Okay, so spreads can move slower when they're right close to the floor or ceiling. The middle 40% of a spread moves the fastest. It moves the closest 1-to-1. Like the top and bottom 30% of a spread may move more like 0.6 or 0.7 to 1. So those wide dailies, they're kind of right in the middle. They move a lot faster. Okay, so guys, there's a lot more we can cover about spreads. We'll be talking about spreads more and more over the next several weeks here. You can also visit the Nadex site and the Nadex YouTube site to catch up on tons of other videos that are there regarding spreads, how spreads work, how to pick the right spread, different ways to trade them. Okay. Also, feel free to visit us over at apexinvesting.com. We have literally hundreds of hours of free education. There's some step-by-step training courses on there that walk you through. You know, I made a whole training course that kind of walks you through step-by-step everything you need to know about binary spreads. We have some free binary and spread scanners. We have some news calendars, free deviation levels, tons of stuff you can check out over there absolutely for free. You can check out the binary scanners where you can see all the different binary options that are available to you all on one page. Same with the spread scanner. Helps you really find the right spread. Shows you all the different spreads all in one place. Shows you the risk and reward. It's all totally free to use there. So check that out. And while you're at it, check us out at facebook.com/apexinvesting. Like us and follow us on Facebook. Once you've liked us on Facebook, make sure to go in and click all posts. That way you get notified of everything there. Just a great way to keep up with upcoming webinars and any great news events coming out that you need to be aware of, and just keep up with anything new coming out. Preston says, can I open a demo account without a deposit? Yes, you can go right over to nadex.com and you can open a demo account. You do not have to have a live account with live money in order to have a demo account. You can go in there and get a demo account right now and start checking out, start playing with these spreads. Okay. Let's see here. Eric, you can ask us that over on the Apex site. We'll be happy to help you out there and direct you any way we can there. And okay, Lewis, you're very welcome. Guys, I appreciate you joining us tonight. I hope this helped open your eyes up a little bit to the world of Nadex spreads and cleared up a few misconceptions about how spreads work, how those different floors and ceilings are figured, and how those are come up with at the top of every hour. And I think particularly about how to place those orders and exit early, and placing those take profit orders. Several of you said, oh, light bulbs there. I never understood quite how to do that. So I hope that helped, and look forward to seeing you next Monday night and each and every Monday night at 7 p.m. Eastern Time. All right, guys, thank you so much for joining us. We will see you next week. Have a great evening.